Margin 101. The simplest way to think about margin is to think about borrowing to invest. This is also known as leverage. It gets this name because, like a lever in physics, which allows you to amplify a force, leverage in investing can allow you to amplify the possible returns or losses of a trade. A margin account is simply an account that has access to margin when there are margin-eligible securities in it. But just because you have access to margin doesn't mean you need to or have to use it. The basic idea is that you hope to earn a higher rate of return on your investments than you pay in interest on the borrowed money in order to increase your potential returns. If you are familiar with the concept of a mortgage on a home, then suppose you have a $1 million house and a mortgage balance of $700,000. The equity you own in the home is $300,000, or 30%. Similarly, if you owned $100,000 worth of stock, but the amount borrowed was $70,000 for that stock, then your margin is $30,000, or 30%. So you can think of the margin percentage as the same as the equity percentage in a home. It represents how much you own out of the total value of the holdings. This is an important concept because there are limits to how much you can borrow and how much margin you need to have in your account. How margin trading increases potential returns and losses. Margin loans can increase potential returns but can also increase potential losses. Let's see what would happen if our margin stock either went up or down 10%. Without margin, the calculations would be simple. If we only used our $30,000 cash to buy $30,000 worth of stock XYZ and it went up 10%, our market value would be $33,000. If it went down 10%, our market value would be $27,000. So we'd either be up or down $3,000 less the costs of executing the trades. But for our margin trade, let's see how the gain and loss are both increased. Let's say we used $30,000 cash and borrowed $30,000 for a total position size of $60,000. If that went up 10%, we would have $66,000. We would still owe $30,000 on our loan, and if we sold our position and paid off the loan, we would have $36,000 left over. We would have increased our cash position from $30,000 to $36,000, which is a gain of 20%. This gain will be reduced by trading commissions as well as the interest on the borrowed funds. This sounds lucrative, but consider what happens if stock XYZ went down 10%. Our $60,000 initial position is reduced to $54,000. We still owe $30,000, so if we sold our position, we would be left with $24,000 after paying back the loan. We would have lost 20% relative to our starting $30,000 cash position, and again, we would additionally have to subtract trading commissions and the interest charged for borrowing funds. So again, while the stock moved 10%, our margin trade moved 20% due to the leverage. Margin calls. If you use too much margin and or your positions lose value, you can get a margin call. Your brokerage may ask you to deposit more cash to your account or to sell some securities. Pros and cons of trading on margin. It should be clear that margin trading can either magnify gains or losses. With a margin account, you can instantly access borrowed funds, and because the securities you own serve as collateral, these are secured loans, and that means the interest rate on the loans is generally going to be quite favorable. So while the interest charges reduce your returns, as they are an added cost, that cost is generally quite low. One of the bigger risks to be aware of is how margin calls can affect your performance when your trades are not going in the direction you had hoped. With a buy and hold approach without margin, if a stock dropped in value and you were patient, you could hold your position in the hopes of the share price regaining its value. But with a margined position, if you get hit with a margin call, you may be asked to either add more cash to keep your trade open or partially exit your trade at a potentially inopportune time in order to keep your account's buying power above zero. If you have a higher risk tolerance and capacity to stomach losses and have taken the time to learn more than just the basics of investing, you might be curious if margin is right for you. If you do fall into this category, hopefully now you have a better appreciation of not just the potential performance increase margin offers, but also the potential downside considerations as well.